stop maxing out your 401k before you understand this tax trap that comes with it. 401ks are great. For anyone who doesn't know, it's an employer-provided plan. 401k, 403b, 457b. It allows you to contribute your own money to a retirement investment account. And oftentimes the employer will give some sort of a match, be it 3% or up to 6% of your total salary. And that match part is great. That match part is free money. So what traditionally the advice is, at the very least, contribute up to the match, which you should do because you're getting free money by doing that. However, the question you need to ask yourself is, should I be contributing more above the match, where you're not getting any more free money from your employer for that? And the question, it's not a yes or no, it's what are the consequences if I do that? In order to fully understand that, we need to understand the taxability and the tax ramifications of a 401k. So while you're working, you're thinking, oh great, I'll throw this money in there. I want to get to retirement, and it's a retirement account, right? So what else should I do? So put your money in this 401k, and over time it grows. Let's say you're 35, 45, you have 20 or 30 years until you're going to pull that money out. Whenever you contribute to a 401k, you get a tax deduction of whatever amount that you contributed. So that could lower your income in the current year. All right, so that sounds great. What's the bad parts of it? With that deduction, there is a catch, because eventually, when you get to the age you want to start pulling money out from that account, anything you pull out is fully taxable. So yeah, you get a temporary deduction for that, but the government is essentially going to pull that back when you pull the money out of the account. So it's a temporary deduction. It's not some permanent deduction, because when you pull that money out of the 401k, it's entirely taxable. So, all right, let's dive into the consequences for that, or what could potentially happen, the ramifications. Let's dive into the ramifications of that. Let's say $15,000 a year, and you're doing that over 30 years. That's in contributions, $450,000. Now, let's look at the compounded growth of this account year over year. The likelihood is, by the time you get to pull money out of that account, you've got over $1 million in there. And eventually, once you hit either age 73 or 75, the government is going to come telling you, hey, you have to start pulling that out. And they're going to tell you exactly how much every single year. Now, guess what happens? You pull that money out, it gets added entirely to your taxable income. And there's a likelihood that the money they're telling you to pull out is more than you even need, because you're probably going to have Social Security at that time. Maybe you have a pension or some other income funds. And yet, even if you don't need the money, the government's telling you have to pull this out. Let's say now you have to pull out $40,000 a year. What is that going to do to your tax brackets and your retirement situations? It potentially will make your Social Security taxable. It potentially will put you in a higher tax bracket. And it potentially will cause you to pay more money in Medicare tax. Wow, those are some real steep consequences. I heard I should just contribute to my 401k. What someone who tells you that is really trying to say is either one of two things. Either one, they're giving you that advice because you're forced to keep it in there until you're 59 and a half, and they don't think you can be trusted with your own money. And for some people, that is valid. There are some people who, if they have money in an account they can access, they're just going to pull it all out. So having that guardrail of, hey, you can't pull it out before age 59 and a half, for some people, that's going to be a valid reason to do that. However, anybody watching this video, if you're smart enough, you care enough about your own retirement to search out this information, I don't think that applies to you. So let's go get into the second point. What they're really saying is just you should contribute to an investment account. And they're saying 401k because that's what most people know of, but in reality, for most people, the best solution is going to be, A, you're always going to want to, if you're financially able, you're always going to want to contribute up to the match in the 401k. I don't dispute that at all, because you're getting free money there. The question again becomes, what happens when I get above that match amount? Now, it really, obviously it goes to your specific situation, but it really comes down to, okay, maybe investing in a brokerage account where you're only taxed on the profits and it's only when you buy or sell are you ever taxed. That may be a better scenario, because all of a sudden, if you built up this big account, but most of the account is contributions, money you physically added, you're not paying tax on that money when you pull it out. You're only paying tax on whatever you make in profits. And that you have the ability to control, because each year you can say, okay, let's go ahead and sell a good amount now. I want to clear the capital gains. And so that this way, when you go into retirement, you can know, okay, I'm 65 years old now, I'm retiring, and all this money has already been either taxed or it's just in the account. And guess what? In a brokerage account, there's nobody ever telling you, hey, you have to take out this money. Now, the tax part of the 401k is just one drawback. The other drawback is that when you're contributing to an employer plan, each employer has specific rules, such as the level of investments that are in there. That's any 401k is limited. 401ks only have the option of including mutual funds in there, which often are high cost. They have high fees in addition to the program fee you are paying. And yes, you are paying a program fee. I used to work on the 401k administration side of things, helping with plans such as Coca-Cola plan, Baptist Health, major companies. So I've seen the back end of these plans. You are paying a fee. They just don't include it necessarily on the statement. But if you get the plan documents and you really look through them, everybody's paying a program fee. And guess what? There's nothing wrong with that. All right. It's just important to know you are paying that fee in addition to the fees of the individual funds that are in the plan. And they don't let you choose. It's only mutual funds. That's by law. And there's usually a very limited selection of funds you have to choose from there. So that, on top of the fact that you have to adhere to the employer plan, they can move your account to another company without even telling you. You're with Transamerica one day, the next day it's, oh, hey, why do I have an email from Prudential? Oh, your 401k plan's with us now. This can happen over and over again. Every time it moves, you have to create a new account somewhere else. Whereas you create a brokerage account for yourself outside of that, whether that's Fidelity, Schwab, Raymond James, that account doesn't get moved unless you decide, hey, I want to move it somewhere else. Which of those sounds better? To summarize, those are really the traps you can get into with over contributing to a 401k, because the key thing is you lose control. And what I always tell my clients is when developing a plan, we want to be in as much control as possible. And making decisions that takes away our control is never a good thing. And so what happens is we lose control, and then all of a sudden, we're later on down the road, we're approaching retirement, and now we've put ourselves in a high probability of increased Medicare costs, increased taxes, increased Social Security tax. That's not good. And so those are really the trap with 401ks. And what we do is, for anybody who watches this video, a complimentary consultation. If you'd like to talk to us, it's over Zoom, no frills, no pressure. Just click the link down below, click the link in the description. If you're not ready for that, but you did this video, make sure to like and subscribe. And also, if you have any questions or just want to make sure to comment down below, we'll be in the comments as well. Thank you for watching. You all have a great rest of your day.